Futures versus options trading, which one is best for you? Let's find out. Alright, so before we can decide which one is better for you, we have to understand how each of these works and dive deeper into the pros and cons of each one. So let's do that real quick. Let's start off with futures contracts because I think they're actually a little bit more simple than options. So futures contract, I'm not going to explain exactly what a futures contract is. If you're interested in that, you have Google and YouTube for that. So you can just go ahead and type what is a futures contract, right? But essentially, you're allowed to long or short the market. You long the market by buying to open, and you short the market by selling to open. Now, some people get tripped up on that because they're like, how can you sell something that you don't have? Again, if you guys want to go deeper into how that works and all that, just give it a Google search and you'll and hopefully that will help you understand how that works. But yes, you can go short the market, which basically means you're betting that the market price will go down, and if it goes down, you will make money. That's basically, you know, really simplified, but that's basically the essentials you need to know. And obviously we know with options, there's a lot more options that you can go into it, like different strategies like iron condors, straddles. For the most part, I think most people watching this video are just, you know, gonna focus on going long or short the market. And now let's talk about which contract you can decide to actually trade, because we know with options, you have an option on the expiration date and you have an option on the strike price. With futures, it's a lot more simple because that strike price option is eliminated. There is no strike price you choose. You just either long or short the contract itself. As far as expiration date, futures contracts do have an expiration date, but they're not as important as an options contract where, you know, you have the option to choose today's expiration, tomorrow's expiration. Futures contracts more so have like monthly expiration contracts. And again, they're not so important because you're not dealing with stuff like theta decay. So in that sense, you don't really have to worry about it too much. And most of the time, the broker will automatically roll you over to whatever is the nearest expiration contract. And again, they don't have like daily contracts or anything like that. They just have monthly expirations. The third thing about futures, which I kind of mentioned already, is you don't have to deal with the Greeks. And the Greeks are basically what an option contract's value persists of, or how it's going to be affected. And the main Greeks to focus on are delta, which is how much your contract is expected to go up or down depending on $1 price move in the underlying. The underlying being whatever stock you're trading with that option. Then you obviously have theta, which is the time decay, how much value your contract is expected to lose per day that you're holding the contract. So you're actually losing value as the contract nears expiration date. You also have to worry about IV, which is implied volatility, and that basically measures the expected move the stock is expected to have. And based on other people's bets using options, you know, I'm not exactly sure the formula they use to calculate this, but for example, if a stock is expected to have an earnings release, obviously people are going to expect a move coming out of that. There's going to be a reaction from that, and so that move, that expected move, is going to be priced into the options. So if you're trying to buy an option going into an earnings play, it's going to be a lot pricier than it would normally, right? We also see this going into like FOMC meetings because people obviously expect there to be a big move in the market, and then right after the meeting, the implied volatility is going to get crushed. So the value of the options is going to decrease dramatically because the move has already happened. So the expected move going forward is a lot less. It's going to be a lot less volatile than what was expected previously, if that makes sense, right? And with futures contracts, you don't really have to worry about that. Obviously, if you're going to be trading in a really volatile situation like an earnings play, you do have to be aware of that, because takes us to our next point, which is with options, this is a big pro it has over futures, is you have a defined risk amount, right? Let's say you're going to buy an option contract that's $5, which in reality is $500 because options have a multiplier of 100. The maximum you can lose in that play is $500. But with the futures contract, let's say you go long one futures contract, the maximum you can lose is essentially more than the value of your account, right? And the reason this is because when you're purchasing a futures contract, or when you're trading a futures contract, I should say, it's not the same as if you're buying a stock or an options contract where you purchase it and it has like a value. Instead, the way you're able to hold one of these contracts is the broker requires you to have a certain margin in your account in order to hold that contract. And what a margin requirement is basically they're going to tell you, okay, you need to have at least $1,000 in your account so you can hold one of these contracts. If you want to hold two of these contracts, you have to have a minimum balance of $2,000. But obviously there's going to be a fluctuation in the price of the contract, so it's recommended you have more than what the initial margin requirement is. They're requiring you to have $2,000 in your account to hold 2 contracts, and you want to comfortably hold 2 contracts, you should probably have $3,000 or double the initial margin, $4,000, to hold the contracts and not have to worry about getting auto liquidated, which some brokers, like the broker I would recommend for most beginner futures trading, Trade08, they have an auto liquidation policy, which basically says if your account drops below the margin requirement, they will auto liquidate all your positions. They will sell them, which is kind of like a safe net in place. That way your account doesn't go, negative thousands of dollars below your whatever money you put into your account, because that can happen, right? You can lose a lot more than what's in your account, which is something you have to be really aware of. But with this auto liquidation process, they kind of prevent that from happening. But still, you still have to, obviously, you don't want to get auto liquidated, because that means you probably lost a lot of money. And I think they do charge you a $25 fee for your first auto liquidation, and then after that they charge you a $50 fee. So just keep that in mind, and just always have a lot more in your account than what the margin requirement is. So now let's actually go into what are the margin requirements, right? What is the amount of money you need in your account to trade futures, or to start off trading futures if you're interested. Again, it's going to differ based on what broker you're using. Also, the commissions are going to be a little bit different. I know a lot of people complain about Thinkorswim having pretty high commissions for futures trading. But the broker I would recommend you guys start off with future trading if you're like interested in starting out and like dipping your toes into it to find out like how to trade them. Is Trade08. They also allow you to paper trade them, so I would recommend that starting off. That way you could just get a feel of it. Their margin requirement. So there's 2 different contracts, or 2 main contracts that people like to trade. They like to trade the E-mini S&P futures. You can also do this with Nasdaq. Nasdaq is basically QQQ for those of you that trade options. And ES is basically SPY or SPX for those of you that trade options. So, and there's a lot more products available with futures, but today we're just going to go into the basics. You can also trade oil, sugar, all these other commodities and all that stuff, but we're not going to talk about that. We're just focusing on ES futures basically today. So again, like I said, there's 2 options. You have E-mini S&P futures. Your margin requirement for these, I believe, is like $500 per contract. Let me just double check that real quick. Yeah, so the margin requirement, if you want to trade them during trading hours, is $500. If you want to trade them after hours, which is another thing we're going to get into right after, you can trade these after hours or when market is closed, because futures do continue to trade. And then the initial margin requirement for the E-mini S&P is $11,000. So it is a pretty big margin, initial margin. But if you just want to scalp these or day trade them during the trading hours, it will be $500. And if you want to trade them, day trade them, scalp them in the after hours, it will be $500 margin per contract you want to hold of the E-mini S&P futures. And so now you may be wondering, okay, how much money am I going to make if the market goes up? How much am I going to lose? What are the commissions like? The commissions come out to be about like 130, 60 cents per contract that you buy and 60 cents per contract that you sell. So 130 round trip, or 120 actually round trip. How much you're going to make is per tick, and per tick is basically 0.25 that the S&P futures move. You will make $12.50 or you will lose $12.50, and for every point that the S&P futures move, you will make or lose $50 trading the E-mini S&Ps. Now, if you have a smaller account, you can trade the micro E-mini S&P futures, which are basically E-mini S&P but a lot smaller. So the margin requirement for these is $55, and you will stand to make or lose $5 per point and 1.25 per tick. And as I will be showing you guys, you don't need a massive account to trade these. I started an account with $150 just to demonstrate to you guys how futures work. You guys can see it on the screen right now, and you can see that I'm placing a short on micro E-mini S&P futures, which means I'm betting the price will go down. This is my average price here on the screen, and you can see right here I'm -1 contracts, which basically means I'm short on the market. And then you can see my open P&L here, and you can see every tick that futures move, I stand to make $1.25. And I was trading this last night in the after hours section, because I was preparing to make this video. And then just basically other things to know about trading futures is, 1, there is no PDT rule with futures trading, which is a huge benefit to those of you guys that don't have a larger account. There is, a way to bypass the PDT when you're trading stocks or options by using a cash account, but you're still limited to only being able to use the settled funds you have. So once you already use those funds for that day, you can't reuse them. And so you're still basically limited on how many day trades you can place. With futures, you can place as many day trades as you want, even if your account is below the 25,000 PDT requirement. Obviously, you do have to worry about the commissions. They do add up, especially if you have a smaller account. So that is something to be aware of. But I think it's a huge benefit not having to worry about PDT. You have basically a tax advantage where you're taxed 60% at the long-term rate and 40% at the short-term capital gains tax, and there are no wash sale rules when you're trading futures contracts. So that's a pretty decent benefit right there. Index options also offer this, so it's not a huge advantage over options, but if you're trading just options on Tesla, Apple, you don't have that same advantage there. So hopefully you guys didn't have too much information, or you just hadn't ever discovered or dove into what futures contracts were or what futures trading was. Hopefully I helped you guys understand a little bit more. If you are going to be putting your money into any of these products I mentioned today, I do encourage you to do even more research on your own, because at the end of the day, you are putting your money at risk. And like I mentioned before, you can lose more than the total value of your account when you're trading futures. So be very, very careful and make sure you really understand what's going on before you put any of your money into any of these futures, options, stocks, whatever it is. Do your own research, please, even outside of this video, because this video definitely isn't, I'm definitely not covering everything there is. And I just want to make sure you guys stay safe out there. Options, hopefully a lot of you guys watching this are already familiar with options. Options has basically been what this entire channel has been about. We mostly have been covering options. That's what I've been trading for the past almost 4 years now. But are there still some advantages that options have over futures? Of course there are. For one, like we already mentioned, you have a defined risk amount that you're setting when you enter the trade, right? You're paying a certain amount for the contract. You know how much your total risk is. The maximum you can lose with an options contract is negative 100%. Obviously, nobody wants to lose that amount, but at least you know that that's the complete maximum. Everything goes to shit, that's the maximum you will be able to lose, unless of course you're selling options. And of course, that's another thing with options, is that you have more variability in terms of what strategies you can do, which I mentioned this earlier. So that's another pro or a reason why you would want to trade options. And you also have the exponential nature of options, wherein you can catch these 300%, 500%, 1000% moves on a contract, whereas with futures, right, which I guess can be a pro or a con depending on what you're looking for. But with futures contract, you know exactly how much you're going to be making per point move in the futures contract, how much you stand to lose based on like the chart. Like you can set a stop loss and you know exactly how much you're going to lose. With an option contract, you can set a stop loss at a certain point on the chart, but because there's so many things affecting the price of the option, the Greeks, implied volatility, you kind of have to estimate like how much you're going to be down by the time the contract or the stock price hits a certain price. So now that we've covered all that, hopefully the video is not too long yet. Which one do I recommend for you? You're probably not gonna like my answer, but of course it depends. And hopefully I give you guys enough information so you can make that choice for yourself. But I think my best recommendation would be to give both of them a try. I think, again, each of them offers a different pros, and you might be best suited to trade one of them versus the other, and you might not know it. Like if you've only been trading options your whole trading career, you may be struggling to find the consistency, but then when you move over to a different product like futures, you might find it easier to find that consistency in your trading, and that might be what you needed this whole time. Vice versa, and it could also be vice versa, where you've only been trading futures this whole time and you've never tried options, and then you try options and then you realize I can make my winners so big because of the exponential factor with options, and that might be the thing you need to find that consistency in your trading. So I would say try both of them out. In terms of which one I think it's easier to grow for somebody that has a smaller account, I think that not having to worry about the PDT is a huge thing with people with smaller accounts. So in that sense, I think it does have a big advantage over options trading. But I'm not too quick to recommend it to all beginners, because again, you can lose more than your total account value when you're trading futures, and if you're not really careful with them, you can do a lot of damage with futures really, really fast. So I think a lot of people are actually, best suited with just going with options, because you're still able to grow a small account. I've grown a sub $1,000 account with options. to over PDT before, and it's possible. It's definitely possible. I've seen other people do it as well, and if you guys are interested, I might try to do the same here with futures. I've never grown like necessarily a small account with futures trading to a large amount, because by the time I discovered futures trading, I was already past that small account stage. But like I demonstrated to you guys in this video, I started an account with $150 just to show you guys, just to demonstrate, and so far it's going pretty good. It's been 2 trading sessions, so yesterday's overnight session and today's regular trading hour session, and the account has doubled at this point. It's now at $300 after commissions and everything. So if you guys want to see me continue growing this account, try to get it over $1,000, then we'll see where we go from there. If you guys want to see that, let me know, and I'll make future videos with this futures account for you guys, to show you guys that it's possible to grow a small account. So yeah, sorry for not giving you guys a definitive answer. Again, I would say my best recommendation is try both of them. There's advantages to each of them, and just be careful and be aware of the risk involved with each of these. Options are extremely risky, futures are extremely risky, and do your own research before throwing actual money into any of these products. Probably paper trade them beforehand, just so you can get a feel of how they move, how to get used to the broker, right? A futures broker. Tradeovate is pretty simple to use, but you still have to, you know, get it to how you like it, learn how to place the stop losses, to take profits, and all that stuff. But yeah, that's about it for this video. And also sorry for the lack of videos recently. I just got super busy with stuff outside of trading, and also I just had some problems with my PC. I had to basically build a new PC, and it took a while to like re-download all the softwares like OBS, my editing software, and then get logged back into the YouTube account. You know, once you kind of lose that groove of doing things in a routine, like I had a pretty nice schedule where I was uploading like a video a week there for a little while, and then once you miss that first week after that, it's hard to get back in the groove. So sorry about that. Also, if you guys have any video recommendations or what you guys want me to go into, I would appreciate that, because it's not always the easiest thing to think of new video ideas without necessarily repeating videos I feel like I already did in the past. You know, I only want to upload the utmost quality videos that I think provide a lot of value to you guys, and if I don't think they provide enough value, sometimes I'll record a video and just not upload it, because I feel like I already did this video in the past, or it just doesn't have enough value. It's not worth your time, and I definitely don't want to waste your guys' time. So if you guys have anything you guys want me to dive deeper into, definitely let me know, and I'll make sure to cover that in the future. But yeah, other than that, catch you guys in the next one. Thank you so much for watching. It's been me, Zero, and I'm out. Peace.